Hello, I'm Professor Brian Bushee. Welcome back. This is our final video of our financial statement analysis of Vulcan Materials Company in 2010. In this video, we're going to look for off-balance sheet items, which are not a problem today, but are things that could turn into big problems down the road. Let's get started. Okay, the last stop on our financial statement analysis roadmap is the question of whether there are significant off-balance sheet items that we should be concerned about with Vulcan Materials. So the first that we're going to look at is the operating leases. So if you remember from earlier in the course, these are long-term, non-cancelable contracts to rent buildings or equipment. And there were those four criteria that determine whether it's capital or operating. And we talked about how these could be structured in a way where these really should be capital leases and be on balance sheet, but you can just get around the criteria a little bit, and in doing so, keep a lot of assets and liabilities off of your balance sheet. So we're going to take a look at how big these are for Vulcan. So I'm on page 74 of the Vulcan report. This is footnote 7, operating leases. First thing they show us is total rent expense for the last few years. So in 2010, total rent expense was about $61 million. And then they show the future minimum operating lease payments under all leases with non-cancelable leases. And here's the payment schedule going forward. Remember, future minimum operating leases means that this assumes this is only for the leases that are in place, and it assumes when they expire they wouldn't be renewed, and so these are the only payments that are now contractually obligated under the lease terms. But as we talked about, that can be somewhat misleading because oftentimes companies have to renew the lease to keep the equipment, and so the actual lease payments may be higher. So why don't we go and take these numbers into Excel and see what kind of liability and amount of assets could be kept off balance sheet by using operating leases. So I brought over the future minimum lease payments that Vulcan discloses in their report. And one of the first problems we run into is the thereafter. It's hard to take the present value of a thereafter payment. So we have to make some assumption on what's going to happen in the thereafter. So just sort of carrying these over, we have to do something with the thereafter. And what I'm going to do is just split it into 5 equal payments of about $5 million, which is where the leases seem to be going. So it's a crude assumption, but at least get us close. So now we can take the present value of each of these streams, and we're going to need an interest rate assumption. So I'm going to assume 6%, because if you go back a couple pages in the Vulcan report, that's about the interest rate that they have on their medium-term debt instruments. So I'm going to bring up the formula and tie it to this 6% interest rate, so I can vary it if I want. Number of periods will be whatever the year is minus 2010. There's no payment because we're going to take the individual present value of a future value, and then the future value is in cell E2. So we figure that out, and we get 25060. I'm going to do that for all of the years and come up with a present value of 84406, which I think is really on the low end, again, because Vulcan would have to shrink their company substantially if they're only going to be paying $5 million in lease payments going forward, given that their rent expense was about $60 million. And so that's what I'm going to look at next is what if we did 8 times rent expense? So rent expense was about $61 million. If we take 8 times that, then we'd have 487. So the liability is somewhere between 84 and 487. Now, another technique you could use is use the present value technique that we did here, but instead of having the payment decline, assume that the rent expense is going to continue around this level and just discount it using the formula. And here you get about 450 million. So my guess is the liability is probably closer to something like 400 million than 84 million that Vulcan's keeping off balance sheet. Their total liabilities are 4.3 billion, or 4372. So basically, what would be 10% of their liabilities are kept off balance sheet through these operating leases. So Doesn't look like there are any questions from the virtual students on the operating leases. I guess they remember that from earlier in the course. So let's go ahead and move on to the next topic, which is pension plans. Now, pension plan accounting is incredibly complicated. You think deferred taxes were bad. I'd probably need 2 weeks of videos to take care of pension plans. But what I'll do is I'm going to go to footnote 10 for Vulcan and try to give you just enough knowledge to be dangerous on pension plans and show you one thing that you should always look for, even if you don't totally understand everything that's going on with pensions. Okay, so I'm at note 10 on page 79 of the Vulcan report, where they talk about their pension plans. Now, where the accounting comes in is for what are called defined benefit pension plans. A defined benefit plan is where the company promises to pay its employees a certain monthly amount after they retire until they die. And that monthly amount is based on what their salary is just before they retire. So defined benefit means that when you retire, you're guaranteed to get a check from Vulcan Materials every month with a certain pension plan. So what you have to do to account for this is, first of all, show how big the liability is for these future pension payments. So this projected benefit obligation of $761 million, this represents the present value of all of the expected payments they have to make to retirees after they retire. So what they would do is they get an actuary. The actuary would forecast out how many more years people will work until they retire, how much their salary will increase until then to figure out what the payment would be when they retire. Then they'll try to guess how long people will live before they pass away and the payments stop. They'll take all those payments in future dollars, discount them back to present value. The total obligation in present value terms is $761 million. Now, to meet this obligation, companies have to put assets into the pension plan. And the idea is that those assets are going to grow to pay off the obligation. So they'll put money into stocks, bonds, mutual funds, and hopefully those assets will grow to meet the pension benefits. So at the end of 2010, Vulcan had $630 million of assets set aside to meet $761 million of expected benefits. That means their pension plan is underfunded by $131 million. So they don't have enough in assets to cover all the expected payments they're going to make to retirees when they retire. Now, this 131,081 does show up on the balance sheet. So this part is technically not off balance sheet. There is a liability for $131 million that Vulcan has on the balance sheet. But here's where this is something to look for. So these pension benefits, or this pension obligation, is guaranteed by the federal government. So there's an agency called the Pension Benefit Guarantee Corporation, which will step in and make the payments to the retirees if Vulcan goes bankrupt and can't do it. But because the government is providing this essential insurance against default for these payments, the government charges Vulcan insurance premium in order to provide this insurance coverage. And the government also has some influence on making Vulcan put enough assets into their pension plans so that they're not severely underfunded, where we could get into the problem where they can't pay their pension benefits. And if you notice, in 2009, Vulcan was underfunded by $216 million. That's gone down to only $131 million. What happened? A big part of that is that Vulcan put more cash into its pension plan. They put more assets aside. And so here's the big thing to look for. If this net amount recognized, this underfunding, is big and negative, there's a good chance that Vulcan's going to have to put more cash into their pension plan in the future. So instead of taking their operating cash flow and investing it in buying new property, plant, equipment, or using it to pay that substantially big dividend, my guess is in the future, because of this underfunding, Vulcan's going to have to take some of their cash flow and divert it into their pension plan. So just find this net amount recognized, which is also called funded status. If that funded status is big and negative, it's a good indication that the company is going to have to divert cash from running the business into its pension plan in the future. So surely the virtual students must have some questions about this, right? Huh, there are no virtual students here. Are they caught in traffic? Did they go out for coffee? Are they studying for the final? I guess we'll carry on without them. Next thing we're going to look at are contingent liabilities that Vulcan has. Contingent liabilities are things that are not liabilities today. So they're not on the balance sheet today, but they're items that could turn into liabilities at some point in the future. So it'll be things like purchase commitments, lawsuits, guarantees, and so forth. So let's go to Vulcan's Note 12 to take a look at those. Okay, so I'm on page 90 of the Vulcan report. These are commitments and contingencies. So the first thing they have are some commitments in terms of contracts they've signed which obligate them to purchase things in the future. So they've signed commitments to buy about 10 million of PP&E and about 68 million of other stuff. And then you can see how this shows out into the future. So this is not on the balance sheet yet because there's been no transaction, there's been no exchange of cash, goods, or services. But the assumption is in the normal course of business, Vulcan will probably spend this cash to buy the property, plant, equipment, and other stuff. They also have commitments to pay out under royalties for mineral leases, which are about 227 million. Again, this is not a liability now because there's been no obligation or transaction that's been triggered yet. But in the normal course of business, Vulcan will have to pay out approximately 227 million over the next few years under these mineral leases. Next thing is they provide guarantees, standby letters of credit. So that's about 65 million that they're potentially on the hook for, that they could borrow up and then owe to banks. And then what is a big deal for Vulcan actually is getting into government proceedings pertaining to occupational safety and health. So no surprise, you're digging up stones from the ground. You have plants where you're making asphalt. You have to worry about employee safety and pollution. And so they talk about all the issues that they've run into. So there's some notices from the U.S. Environmental Protection Agency about some problems. Maybe Superfund sites, that's where you have a big spill of some kind of chemical or pollutant into the ground that then has to be cleaned up. And what they say is, based on the information currently available, the ultimate resolution of those claims will not have a material adverse effect on our operations. Now, that's as of what they know right now, but of course things could change, and all of a sudden, the Superfund site, they could find even more bad chemicals, and this could turn into a big liability at some point in the future. So this is something you want to keep an eye on. Then Vulcan has been subject to lawsuits. So there's Florida antitrust litigation regarding Florida Rock. There's a problem with the IDOT Joliet Road in Illinois where they may have damaged it with some of their operations. There's the Lower Passaic River cleanup in New Jersey. There's the usual perchloroethylene cases that all companies seem to run into. And there's just a number of places in California, Suffolk County, I think that's Long Island, U.S. Virgin Islands, that are suing them. West Virginia is suing them over this. There's West Virginia coal sink lab litigation, and so forth and so on. And then they say it's not possible to predict with certainty the ultimate outcome of these legal proceedings. No liability was recorded at this point because they could not reasonably estimate it. So essentially what happens is until Vulcan gets to the point where they can reasonably estimate a lawsuit loss, they don't have to record a liability. Now that doesn't mean that there's no potential obligation down the road. What you want to do with these is know that they exist and keep an eye on them because these are things that could be not a liability today, but they could turn into a big liability in the future if Vulcan loses a court case or if they decide to settle out of court. So keep an eye on the commitments and contingencies as things that could turn into big liabilities or obligations down the road. And the last thing to keep an eye out for in general are variable interest entities. Now, as it turns out, Vulcan doesn't have any, but these are something you want to look at in general. So let me bring up the section of their 10K where they talk about these. Okay, I'm on page 40 of the Vulcan MD&A. A required disclosure are any off-balance sheet arrangements for things like variable interest entities. So I don't know if you heard about Enron. It was one of the biggest bankruptcies in U.S. history back in, I believe it was 2001. And a big part of what caused the bankruptcy is that investors could not see some of their risky activities because they were in these variable interest entities that were off balance sheet. Now, again, I would need 2 weeks of videos to talk through all of the issues with variable interest entities. But in a nutshell, here's what it is. You set up a corporation that only exists on paper. So it's not a corporation that has a headquarters or buildings or people, but it's all documents where you set up a legal corporation that can do something. And this variable interest entity, this off-balance sheet legal corporation, is set up to do like one purpose, like securitize loans or finance a acquisition of a building or finance research and development or whatever. And basically there's a series of rules where if you structure this correctly, you can take things that normally would be on your balance sheet and move them off your balance sheet, basically hiding any debt involved in these variable interest entities and any assets from your balance sheet. So as a result, if you do these activities, you have to disclose them in your financial statements. And it turns out Vulcan doesn't do them, or if they do them, I guess they say no off-balance sheet arrangements that would have a current material effect. So we don't know if they have no arrangements or none that are a big deal. But if they did, you would see a disclosure here about how those off-balance sheet arrangements might affect their assets, liabilities, income statement if they were on balance sheet. So it's not here for Vulcan, but in general, you always want to go and look for these kinds of arrangements. Okay, to wrap up our comprehensive look of Vulcan materials, what we've learned is that Vulcan's business is largely driven by large construction projects, really driven by highways, federal spending on infrastructure, especially highways. And for Vulcan to turn around, they need recovery of public sector spending, so government spending, as well as the residential and non-residential building segment. Big thing is they need a new highway bill. They need Congress to get into gear, pass a new highway bill, build some more highways so they can sell some more stones for those highways. Their acquisition of Florida Rock in 2007 greatly increased the scale of the company, but the problem is Vulcan hasn't grown into the new scale yet. They're not covering all their fixed costs. They really need more aggregate shipments. The aggregates, again, are the stones, to cover all those fixed costs. And we see they're cutting back on capital investment. And part of the reason is their overcapacity with Florida Rock. They need to get up to capacity for Florida Rock and then start building up their investment to grow even further. Through all the problems with this recession, they're managing their short-term cash position very well. So the management team is doing a great job of managing their cash through these tough times. But as we saw, there's a looming issue ahead with debt principal payments. And having this big dividend on top of these $300 million a year principal payments that come up is going to be a challenge for managing their cash. And it's going to require them to probably keep their borrowing high and try to roll this debt over. But it's going to make the company very risky. So bottom line is if we can just get the government to start building new highways, everything will take care of itself. If not, this is a company that's probably in trouble. So this was the 2010 Vulcan report that we looked at. It's obviously not 2010 anymore, so what happened? Well, I'm not going to tell you. And I'm not going to tell you because I'd like to use this video for the next 10 years if I can get away with it. So if I told you where the company was right now, then this video would be outdated years from now. So what I want you to do is, since you're going to have all this free time now because the course is ending, why don't you go on the internet, download the current Vulcan annual report, and see how they're doing. See what's been going well for them, see if there's anything that's continued to go bad for them, see if they're still around, and try to do your own analysis, sort of like the one that we've done here. You now have the tools and techniques to do it. And that wraps up our look at financial statement analysis. So hopefully you're at a point right now where you could pick up any company's financial statement, go through it and try to pick up the things that we've been talking about this week and learn a lot about what's going on with the company now and have some impression of what might be happening to the company in the future. My only regret as we wrap this week up is that the virtual students weren't here for this last video. I wonder where they are.
Thank you so much for taking the course with us.
We hope that you enjoyed it and learned a lot.
Au revoir.